Leopold Aschenbrenner spent his early career as a researcher at OpenAI before leaving to found his own hedge fund, Situational Awareness LP. By the first quarter of 2026, his fund's 13F filing revealed that its disclosed equity exposure had more than doubled in under 18 months, swelling to $13.67 billion. It was a massive deployment of capital, signaling extreme bullishness on the future of artificial intelligence. But that same filing contained a massive contradiction. Alongside those long positions, Aschenbrenner opened $7.46 billion in notional put options against the primary engines of the AI boom: Nvidia, Broadcom, Oracle, and the Van Eck semiconductor ETF. He was placing a heavily leveraged bet that the world's most valuable chipmakers were about to fall. This seemingly contradictory position relies on a specific assessment of physical limits. The defining bottleneck for scaling artificial general intelligence is no longer silicon architecture, it is electricity. To understand why a premier AI fund would short the hardware running the models, we have to look at how Aschenbrenner's portfolio maps the strict limits of the power grid and how it executes a highly specific institutional hedge against those limits. The prevailing market consensus treats the AI boom as an infinite runway for semiconductor manufacturing. That assessment misses the reality of heavy industrial supply chains, and institutional capital is already pivoting to survive the inevitable collision. The math driving deep learning scaling laws is highly predictable. Historically, the training compute used for the largest AI systems has grown by roughly half in order of magnitude, or 0.5 ohms, every single year. This chart shows Aschenbrenner's projection. The lower left maps the linear progression from GPT-2 to GPT-4. Upward, we reach a 2027 inflection point, systems achieving human-level research capabilities. Once automated, deploying millions of AI agents compresses a decade of progress into 1 year, an intelligence explosion. Facilitating that vertical leap requires an immediate spike in computational power. You need entirely new fleets of GPUs to run millions of automated researchers simultaneously. Because the timeline for artificial general intelligence is compressing so aggressively, the software industry can no longer rely on gradual hardware expansion. The math demands immediate, exponential scaling, forcing the AI industry into a collision with the strict limits of real-world physical infrastructure. A standard commercial data center today draws anywhere from 10 to 50 megawatts of power. The clusters required to train and run AGI models operate on an entirely different scale. Hyperscalers are currently transitioning from $10 billion facilities to trillion-dollar, 100-gigawatt clusters targeted for 2030. A single 100-gigawatt cluster would require more than 20% of the current total electricity production of the United States. The global supply chain for silicon can meet this demand. Logic fabrication plants have the capacity to manufacture the necessary millions of chips. But getting those chips online is entirely dependent on utility interconnection. You cannot quickly scale heavy power generation. Planning, permitting, and building a new gigawatt-class nuclear power plant takes a minimum of 5 to 10 years. This physical timeline is what dictates the long positions in Situational Awareness LP's portfolio. The fund is aggressively buying into Bitcoin miners like IREN and Core Scientific, alongside fuel cell providers like Bloom Energy. These specific entities bypass the decade-long waiting list. They already hold the active grid interconnects, the heavy high-voltage infrastructure, the advanced cooling pipelines, and the secured land that AI hyperscalers urgently need right now. Because connecting to the grid takes a decade, silicon is no longer the rate-limiting step. Active power contracts and secured land have replaced logic chips as the true scarce assets of the AI rollout. Semiconductor chips undergo constant, rapid iteration. They are tech products that historical market cycles show are highly susceptible to overcapacity. This creates an immediate vulnerability. If data center construction stalls because power grids are redlining, hyperscalers will have nowhere to plug in new hardware. The chips will sit in warehouses. A sudden halt in the physical deployment pipeline means a temporary collapse in short-term hardware demand, which directly threatens the current pricing of semiconductor stocks. Current Wall Street models have priced companies like Nvidia and AMD for flawless, uninterrupted exponential growth. Those models assume infinite deployment capacity, completely ignoring the hard limits of utility power and land acquisition. If the physical grid cannot absorb the manufactured hardware, the growth projections fail. That means the semiconductor market is currently operating inside a fragile, highly exposed valuation bubble. To monetize this discrepancy between hardware production and power availability, Situational Awareness LP utilizes a specific risk framework known as a barbell strategy. One side of this portfolio is loaded with heavy capital allocation into highly aggressive, relatively illiquid long positions. These are the physical AI infrastructure plays, the land, the miners, and the energy suppliers. The opposite side of the portfolio is loaded with deep out-of-the-money put options. These function as highly leveraged short derivatives placed directly against the valuations of generic semiconductor tech. Unlike a traditional 60-40 portfolio that aims for middle-of-the-road stability, this barbell avoids the middle entirely. This strategy captures extreme volatility by isolating the specific infrastructure bottlenecks of the AI rollout. Look at how this performs under pressure. If a major player like Nvidia beats earnings and chip deployment scales flawlessly, the physical infrastructure longs surge in value. That surge easily covers the cheap premium lost on the expiring put options. But if Nvidia misses its earnings targets because grid bottlenecks have stalled deployments, the dynamic flips. The physical infrastructure assets, the land and the power contracts, retain their intrinsic value because they remain scarce. Meanwhile, the out-of-the-money put options yield exponential payouts as the chip bubble deflates. By shorting the primary architects of the hardware boom, Aschenbrenner mathematically protects his long positions. It creates an asymmetrical payout structure that wins regardless of where the supply chain fails. The late 2020s are being defined by a specific macroeconomic rotation. Capital is moving violently away from intangible algorithms and hardware iterations and pouring into tangible physical infrastructure. The compressed timeline for artificial general intelligence requires an immediate surge in compute capacity. That scaling process has left the realm of software design and entered the realm of heavy macro-scale physics. The new economy of artificial intelligence operates on a strict physical hierarchy. Electrons, grid interconnects, and raw land are now mathematically more valuable and much harder to acquire than silicon logic chips. The barbell portfolio provides a mathematically rigorous framework designed specifically for this reality. It offers a path for institutional capital to navigate the physical constraints and financial volatility inherent in a rapid intelligence explosion. Thank you for watching. If you got something from this, please like the video and support the channel by clicking on the subscribe button. That really helps us. Thanks again.